Greetings, and welcome back to the Rose Bros podcast. This episode, we are joined by Steve Buytels, CFO at Tamarack Valley Energy, a TSX-listed energy company with daily production of approximately 40,000 BOE a day and a market cap of approximately $3 billion. Steve's experience includes 13 years of energy capital markets, finance, and advisory services as the managing director and co-head of Institutional Equities at Stifel FirstEnergy, as well as a principal at independent investment bank Peters & Co. in the Institutional Equities Group. Steve holds a Chartered Financial Analyst designation and a Bachelors of Management from the University of Lethbridge. We sat down for a smooth cup of Rose Bros coffee and discussed why it's important to protect the balance sheet from downside risk, capital discipline, choosing the correct discount rate, having rose-colored glasses in the energy industry, and thinking long-term. Enjoy. Also, this podcast is sponsored by headracingcanada.com. Looking for high-performance ski gear this winter? In partnership with four-time Olympian Manny-Osborne Paradis, headracingcanada.com is offering the lowest prices possible through its online storefront by passing brick-and-mortar savings on to customers. Check out headracingcanada.com for more info and get your high-performance ski gear for the upcoming season. If you're good, we can get going.
Let her rip.
Steve Buytels?
Yeah.
Thanks very much for doing this.
You bet. It's a pleasure.
You're the CFO of Tamarack Energy. What is Tamarack Energy?
Yeah, Tamarack, that's an interesting question because Tamarack's changed a lot over the last few years, but really our focus is on being the most profitable energy company in North America. I think we strive to be a leader in ESG, and that means a lot. There's three pieces of ESG: environmental, social, and governance. And I think you can see with what we've done with our sustainability linked bonds and with our sustainability linked facility, we're taking leadership and putting our money where our mouth is and linking our cost of borrow and cost of debt to what we're doing as we transition this company moving forward.
You're also pretty young to be a CFO, and that's meant to be a compliment. In the energy industry, that kind of rewards experience and age. It's awesome.
Yeah, it's pretty cool. And you know what? I got to give a lot of credit to Brian Schmidt and the board for taking a chance on a young guy. My life has always been energy. My whole career has been energy. I have a passion for it, and I've lucky enough to be around a lot of good CEOs through my past experience and management teams, for that matter, on the equity capital market side of the business. So when we look at stepping into this role, I've been able to see a lot of good and what doesn't work. And Brian and I make a great team, and all of the folks here, there was a lot of history with much of this team, and it's been a pretty, I'd say, seamless transition, but we've done a lot, and it's been a ton of fun.
It's rare to see a young person in a good position like that. So
yeah, no, thanks. It is. But like I said, I'm fortunate, and it wouldn't be possible without the support of Brian and the team here, right?
Little background, why energy? How did you get into energy?
Yeah, you know what? Energy, always growing up in Southern Alberta, it was, agriculture was a big thing. Energy and Calgary always sort of was something that intrigued me. I think energy is entrepreneurship it's kind of hand in hand. And when you look at how that industry was built, how it continues to transition and morph with everything that gets thrown at it, whether it's government, whether it's the commodity cycle, whether it's, whatever, I think it goes to show you the resilience in the people that are part of this business. And it's like a small town. It really is. To me, it really is. It's a small town, small community, and it kind of fits with how I grew up.
Financial background, you were Peters & Co. investment banking side of things?
Yeah. So equity capital markets been always more on the sales and trading side of the business, to be frank, but always worked and had a part in looking at how to refinance things, being a part of M&A, a lot of good years at, doing that, and kind of got to the end of the line, did that for about 13 years and was looking for a change. And this opportunity came up and came over to take on the CFO role here. But yeah, lots of fun. That business has changed a lot since I would have started, but continue to be heavily involved in working with those guys and gals in the business. And I think it, again, much like the energy business, it shows you like that is a sector that continues to see a lot of support. and has changed a lot. But I think there continues to be a pretty bright path for those investment banks in the energy business.
Not that you don't work hard, maybe you're working even harder now, but those are long hours too in those types of scenarios.
Yeah, you know what, they are. And I remember when I took on this role, my wife's like, oh, you know what, this is going to be great. You're going to have more time. You realize the hours on that business, they're the same. They just start way earlier. So you're actually home on time and have supper with the kids and can do all the kids' sports and activities. Now you're kind of on 24/7. It's just a little bit of a different schedule. So I think she would wholeheartedly disagree that it's less time than banking.
Tamarack Energy is doing really well now. Do you remember March of 2020?
Yeah, very well. I started March 16th. We shut the office down March 18th. So the first thing I did as new CFO coming in here was had to work with the management team and the board on cutting capital. We cut half our capital out to make sure we kept our balance sheet strong, and also had to manage getting people situated to be able to work from home, reset process. I remember it. I remember sitting here buying stock at 40 cents. And my wife looking at me being like, are you sure we should be doing this? Like, everything I'm reading and hearing is energy's over. So yeah, it was pretty crazy times, but again, huge opportunity, and we were able to take advantage of that. Yeah, it was definitely interesting.
Tamarack is an example of a company that there's fragile, there's robust, and there's anti-fragile. Tamarack might be in the category of anti-fragile, where you guys actually got better through the pandemic. Why do you think the company was able to do that?
Yeah, I think, it all starts with the DNA here. And you look at the business Brian built and the processes and the strategy that they had was always making sure they kept a healthy balance sheet and always having a strong risk management program. So going through the downturn, we really did see that as an opportunity. I think the biggest thing we did as an organization, strategy-wise, was change the view of looking at things on a year-by-year basis to moving to a 5-year or 8-year plan that we use. Looking at, for every action, there's a reaction, and you need to understand what that is not only in year 1, but in year 5. So, I think that really set the tone for what we were able to do as a company and take advantage of that downturn.
I don't know the timeline exactly, but one of the main things Tamarack seems to have been able to do is get into the Clearwater oil play.
Yeah.
When did that happen? And why did it happen?
Yeah. So that was the first acquisition we did. And it was really strategic and by design. And I kind of brought that up at the start of this podcast. We want to be the most profitable oil company. So it began with looking at what plays offer you the best margin and are the most resilient across all commodity cycles. So, again, with that 5-year plan, we use a $55 price deck and we never change that. So there's discipline around making sure that just because oil prices are really good, or if oil prices are really bad, and you've got a steady state in terms of how you're making decisions. And the Clearwater sticks out as the most economic oil play in North America. So from that side of things, it was a pretty easy call in terms of what play to target. Getting into it is we were fortunate with timing and with the way the banks were getting forced into pushing some companies into play. We sat there with a pretty good balance sheet and good support from our shareholders to be able to go out and start that acquisition spree that we've been on.
When did you close the first Clearwater?
So the first Clearwater deal closed December 21st, if I'm not mistaken, of 2020. So we, went into that. We raised the first equity financing through all of COVID for the energy space. I think we did 40 million of private placement money, of which the board and management put in a significant amount. I think we were about $3 or $4 million of that deal. So again, we believed in what we were doing in the strategy. We had really good shareholder support. Some of our biggest shareholders participated in that. So, I think it spoke to what they saw in us as a team, our strategy. And you look back now almost 2 years later, exactly, and what we've been able to do. We're the biggest player in the Clearwater. We have a significant land position. And to be frank, the Clearwater, it's still in the infancy in terms of what this play could be. Yeah, it's 100,000 barrels a day. But I think this play is going to look a lot different again a year and 2 years from now.
Similar to Neil Rizal, maybe at Headwater and those guys and everyone else. Lots of people like to say they called the bottom in 2020, but not many people actually put their money where their mouth was. And you guys did.
Yeah, I'm never going to go out with saying, listen, we called the bottom. I think we had to make the right decisions based on the risk associated with those decisions in terms of how we run our business full cycle and look, not just 6 months ahead, but look out again to that 5 years. So yeah, I think we were very deliberate in how we reposition this. You need to sometimes have some luck on your side with timing, but to be lucky, you got to put yourself in a position to have that luck. So I think that's what we did. And yeah, you bring up a guy like Neil Rozelle, or you look at what Mike Rose at Tourmaline did with their businesses and what they've been able to build. Those are two obviously amazing CEOs and run really, really, really strong companies. That to even just be in the same conversation as those two, I think is a big thing for Tamarack. So at the end of the day, the new strategy and the refocused strategy that we undertook in 2020 is really starting to bear its fruit.
Was it an evolving situation, or were you guys kind of biding your time with a healthy balance sheet to look for assets, or did it all happen at once in good timing, or what was your thinking?
Yeah, that's a great question. I would say it's evolving, right? There's lots of opportunity that presented itself. I think what we had to do is really stick and be disciplined to that 5-year plan. What is really going to make us the most profitable energy company? And it was really targeting and sticking to the plays we wanted to get into, which were the Clearwater and the Charlie Lake, right?
So the pandemic came around and you saw an opportunity almost. You had a good balance sheet and prices were low. And
yeah. And I think we got creative with how we didn't have cost of capital. So we had to get creative with how we financed it. We needed to bring in good partners. When I look at all of the deals that we've done, there's been one company that's been beside us the whole way, and that's Topaz. Marty and his team have been very supportive of Tamarack and what we've done in terms of strategy and how we've executed. But again, I'm not going to sit here and say this is all Tamarack. It's yes, it's our people, but it's our partners like Topaz, it's our shareholders, our stakeholders. So, I think we're very lucky to have what we have. We needed all of that support to be where we are right today.
Viewing it as a kind of a bottom-up exercise at, say, like a $50 oil price, that trying to get an asset that would work from there.
Yeah, and it's one of the big questions we get a lot is, how do we know there's going to be discipline if you guys have been this acquisitive? How do we know that works? And what I'm really proud to say is we stick to that plan. It's a static oil price, a static gas price, that we ensure that just because oil is $130, or if oil was $30, we know what we're measuring that against and how that has to be accretive over that long term for our shareholders.
From a capital allocation perspective, sometimes it's easy to grow through equity and all that, but the problem is structuring it right. How did you think about structuring all the deals, and how did you think about sources of financing maybe that weren't there or were there? How did you put it together?
I would say the structure of the financing and the deals that we did played an important role into everything we've been able to accomplish. Making sure that was the right amount of debt that you could take on and you could basically properly manage, but also then pay off in a certain period of time to keep that balance sheet healthy, but most importantly, the capacity to do more. The other thing I would say is it's easy to put out shares, but that's not always the right answer. And when you don't have a cost of capital like us, that was very tough. That's a very tough decision. And we had to balance that. And I think sometimes you don't see that right away, but as you look through the culmination of all of our efforts and what we've been able to build, I think we did strike the right balance in terms of, look at Delta Stream. We had enough debt capacity to do something there and get creative to manage debt at an appropriate level, but also not have to put out a whole bunch of stock. And I think that was really important because when we announced Delta Stream, that was a really tough, volatile time in the market. Equities have since rallied 40, 50% off really that August sort of bottom. That's really important there to make sure we manage that dilution accordingly. But again, I think what our shareholders are starting to see is we take a very pragmatic and disciplined approach in how we've executed M&A. And I think it's all come through in terms of the earnings potential that now exists in this company and the free cash flow that sits here too.
In terms of the cost of capital, sometimes it's a really opaque process of determining that number. Those formulas have a lot of assumptions in them, built into them. They're wrong most of the time. And how did you come up with a number to kind of run your business model off? Was it just the risk-free interest rate? Was it payback on the wells? How did you come up with the number?
There's lots that goes into your cost of capital. I would say one of the biggest things is, what is the appropriate discount rate to use for a company? And, we all got used to discounting things at 10%.
Yep.
That's not right for small or mid-cap oil and gas. That obviously has not been evident in the way the street is valuing these equities. So I think we look at multiple things when we look at NAV in a lot of the way we value things. But again, it comes to what's the right discount. Right? Is it 10? No. Is it 15 to 20? Probably yes. So how do we look at that? You look at, obviously cash flow multiples, and you look at things from a free cash perspective too. You look at cost of debt, your cost of equity. Again, the discount's inherent in your cost of equity, and that is the most expensive piece for us. Debt, even though we have bonds out at 7.25%, that's still relatively cheap and probably half of the cost, of equity at the end of the day. So again, that balance was important to us, but you also can't just lever up and be in a spot where if things turn, you're in a lot of trouble. And we've got a lot of, I think, case studies in which companies went out and did acquisitions and took on too much leverage, and then in part didn't have the right hedging strategy in place that put them in the penalty box for a long, long time, and have finally just come out of that. So cost of capital is important when you look at how you structure deals, but also managing risk and ensuring that you protect the cash flows and the revenue streams to pay down debt, service your dividend, service your capital program. That's all important.
The last maybe 5-10 years has been tough on the energy industry. A lot of people are shying away from investing in the sector, and perhaps it's harder to raise money than it used to be. Did you guys find it was hard to get the money you needed, or was it kind of a niche investor that found you, or how did you come up with the money?
Yeah, listen, one of the reasons you're seeing so much capital discipline is a lack of equity in the markets. Is it loosened up as of late? Yes. Is it what it used to be? No. And I think that's probably a good thing because, listen, the energy industry full cycle, I'm going to be the one that says it here, never really, and I'm painting a broad brush, they had fairly poorly return on capital employed. So I think we needed a reset as a business and as an industry, and I think the right things are happening now, but I do think it's going to take time still for capital to come back. But in that is really the opportunity. Those with differentiated models that get support are going to see a differentiation in multiple over time. And with that, a better cost of capital and access, to equity and debt, which in turn should allow the better companies to continue to build their businesses and do it in a very accretive manner.
There's a lot of different strategies being pursued right now, whether it's dividends, buybacks, pure growth, combination of all of it. It seems like there's no right answer for companies. Maybe it's a balance between all of them. Do you have a preferred way to go, or is it all of the above?
You know what? And I don't want to use the word all of the above, but it sort of is all of the above. We view a really balanced sort of portfolio approach in how we look at things. Ultimately, there is the right recipe. You have to continue to reinvest in your business because, again, as I've talked a lot about that 5 and 8 year plan, you need duration and longevity in that free cash. So it's all fine and good to just pay out as much free cash as you want today, but what about tomorrow and what about the year after that? So we believe in striking a good balance and looking at a total return plan where there is return on capital to investors for sure. That's key. But most importantly is ensuring we're running a business that continues to grow free cash. Because if we can do that, you're going to get more as an investor over the long term. So, it is a little bit of a patience approach and a balanced approach, but we strongly believe that. And whether that's more organic growth at a point in time because your assets pay out 2 to 3 times in a year, which in turn should give you more over the long term. That may be it for us in the short term right now, just given we're digesting the Delta Stream acquisition. I'd say debt pay down, number one priority here, really integrating and executing on the acquisitions. And then really then again, morphing back into that balance of returning the right amount of capital, continuing to, reinvest in the business to make sure we have duration and inventory, and then striking the right amount of growth, right? And that all those 3 things really do play together.
Clearwater is one of the best plays in North America. Is it tempting to just go crazy on the drill bit and really juice things up? Absolutely. I mean, look at the pure play Spur and Headwater. The proof's in the pudding in their numbers. It's hard not to grow. And they're growing while spitting out millions and millions, hundreds of millions of free cash. Yeah. Not dissimilar to what
what we're doing. And, our team was in here the other day presenting the Clearwater monthly forecast. And it's just shocking to see the amount of growth and free cash that comes through. So yes, in short, it is hard not to just go pile money in. But we all know there's other consequences to that in terms of what happens with your decline rate, what happens with the sustainability capital moving forward. So again, that balance is key. For us, it's balancing near-term debt pay down, so maximizing free cash, the proper amount of investment in the business to do so. Again, these are all good questions and answers that we're going to come to the market with as we get ourselves in a position where what is the right amount of inventory to have, how much value is appropriate to bring forward, and then what does that longevity of that and sustainability of that free cash look like. We're excited. I've never in my career seen a play like this, ever, that generates so much free cash and allows you to at the same time grow it at such a big rate. But again, I think we have to preach discipline around how we run the business, looking at it from a long-term perspective.
Growth is risky too. If you miss 2 or 3 wells and you announce it, it can be tough on the perception of the company, and the, short-term money, fast money is they want the results tomorrow, right?
Yeah. Yeah. And you know what? I'd say we're still at a stage in the market where you have energy investors that you had Rafi on your podcast. You have investors that know the space that are more long-term focused, but you still have a lot of short-term renters in this space, which is unfortunate. And it's exactly to your point. So they're looking for the latest news. For us, we want to focus on the long-term investors, the investors that want to be a part of the story, that understand strategy and understand over the long term what we can do as a company. We want them to have comfort in how we run the business and that they can sleep at night. So I don't want to live and die by my latest press release. That's not how we're going to work it here. And, I think if you look at, again, what Brian has done with building the team here and really the DNA of the company is a calm, a measured, and a disciplined approach. And that's how we look at everything.
One thing people like to highlight or do in entrepreneurial activities is have skin in the game. It really aligns management with the company and the interests of the shareholders. I think I read you own about 900,000 shares. Brian owns a bunch. So that would be a way to point to the fact that your interests are aligned with shareholders too.
Yeah. I've always been a big believer, from my days on the equity capital market side of the business, that you need insider ownership. There's no question about it. You need skin in the game. You have to make decisions that are right for shareholders, and that's how you do that. So at the end of the day, very important to us, we have specific thresholds we want all of our executive to have here. We really internally have always promoted strong insider ownership across all levels of our staff, from management right on down. So, that's important to us. And I think if you go back and you look in history at the strongest performing companies, irregardless of the sector, you're going to always have pretty good alignment with insider ownership.
Has it been hard to find the long-term shareholder that sponsors the company with a good, solid understanding of the industry for the next 5-10 years? Or is it a lot of fast money? Or have you guys experienced that?
Yeah, it kind of goes back to what my earlier comment there, where unfortunately, there's still a lot of fast money. But again, there are specific pockets of longer-term shareholders. And we need to be patient too as an industry. We need to gain their trust back from, years of probably mismanagement as an industry. And again, that's broad brush. There were companies through that, including Tamarack, that I think have done a very good job running real businesses and managing it on behalf of shareholders in a very deliberate manner. But that doesn't speak for all. Yeah. And the returns have not been there. And I think that's where the patience is needed from the companies and industry is, let's give it some time, and the proof's going to be in the numbers. And as we continue to press release as an industry, very strong numbers moving forward, I think a lot of that confidence is going to come back. That's probably what excites me the most, and the biggest opportunity in the space is what that transition in investor appetite and ownership looks like as we move through the cycle here.
One of the worries of the generalist investor, along with imprudent capital allocation, would be that oil price. When there's a shortage like we have now, people worry that companies are going to go out and drill a bunch and that oil prices will just fall, or the conflict in the Ukraine will stop, or something will happen and oil is going to crash again. Does that worry you guys? How do you think about that in terms of the company and going forward?
Yeah, we have to have a long-term view, right? So there's a lot that goes into the play. And you got to remember, we're in a cyclical business.
Yeah.
So it comes back to how we manage that business. 55 TI is our long-term price in our planning deck on our 5 and 8 year plans. If price is better than that, that's great. That's a win for us. And then we have to manage risk appropriately to the downside too. So we hedge systematically and make sure that we cover our sustaining capital, our base dividend, and any debt servicing that we have to be able to take care of. So I think for us, we're always going to have a view on what the commodity is doing and where it's at. And yeah, we're pretty constructive right now with everything going on, and probably less so because of the events of the Ukraine war and so forth. We think there's been structural underinvestment in this space, both in oil and in gas for many years, which has set us up into a very interesting new cycle. I don't want to call it a super cycle, but a new cycle where we probably have higher commodity prices. So we'll hedge to manage appropriately the downside. But for I'd say the near to medium term, we're pretty constructive in terms of where we think the commodity prices are going to sit. I think right now, the thing that probably keeps us up most at night is what's going to happen with the heavy differentials. And there's a lot that's out of our control with refinery fires and outages, the SPR releases, things like that. So all we can do is hedge appropriately around events like that. That's why you do hedge. But at the end of the day, I think we run a business that when I talk about being the most profitable company, you have a lot of margin to be able to sustain volatility. That, in conjunction with our risk management, is what allows us to sleep and gives us comfort with managing through a cyclical business like we run, right?
Rafi's comment was that it's a big ship and it takes a long time to turn around. It's been years of undersupply, and the worry that it's going to fall off a cliff tomorrow maybe is mitigated by the fact that this big ship is going to take years to turn around in terms of supply, and that we're hoping for decent oil prices now for the next 5-10 years.
Yeah. I talk to Rafi a lot. I would share a very similar thought to Rafi there. It is a big ship you're trying to right. That will take a lot of time. So I don't see a bunch of supply coming. Are you seeing reinvestment now? You bet. I mean, you read every day where there's new blocks opening up offshore, etc. I think what was the easy, quick cycle production, i.e. the Permian, that's in a lot tougher spot. Right. So I do think it'll take time to see meaningful supply come back. And again, that's why, we would share a pretty constructive view over the next few years for sure on commodity prices here.
So for the listener, you're not seeing the US, the shale revolution, all that, you're not seeing that jump up again?
No, I think what you're seeing is you are seeing growth, but it's definitely at a slower pace than most would have predicted, especially when you look at the amount of still rigs running, the capital still going in. You are seeing more capital discipline by the US producers, which was really unheard of until the last couple of years here. The private companies down there still are pretty active. But you are starting to see different things like, you look at the Q3 results, the GORs in the Permian starting to pick up. You're seeing efficiencies degrade. You're talking about, the tiering stepping down. So I'm not going to pretend I'm an expert on the Permian because I'm not. But what I would say is I do think this business in general, you always tend to drill your best stuff first. I think that's going to start to come through, and it's just going to be tougher if guys want to remain disciplined from a capital perspective. It will weigh on that quick cycle production growth that you see onshore North America for sure.
One of the criticisms of this podcast with regards to energy is everyone talks their own book. So everyone's rosy right now and everything's great. Energy prices are high. Everyone thinks it's going to keep going, but it'd be crazy not to look at it opposite way. How do you guys think of it in terms of a worst case scenario when things aren't so good, or do you consider that, or how do you present that story to investors who probably would ask those questions?
Yeah. And that's a very fair question because it's easy to have the rose colored glasses on right now.
Because we're in downtown Calgary.
We're downtown Calgary. We're all feeling good again.
Yeah,
but
exactly.
I would say there's a few things that have changed versus other cycles to start, and then I'll go through sort of how we look at it. But there is a discipline. You definitely can see it in the conversations that we all have together as an industry, as we have with investors and the feedback we get from investors. So I think there's a bit of a learning that's happened there. Back to your question on there is a lack of equity available. There isn't equity to just go grow. There's no new oil sands projects coming on that are material from a growth standpoint. That can't happen anymore. So when you look at that discipline, I think that's going to help. But again, when we look at our business, you got to look up and down. Right now, it feels pretty good. But again, as I said, I think we feel, and I'm repeating myself in the sense that we run this at a much lower oil price from a planning perspective, and we have a very strong systematic risk management program in place that puts a floor into what we need to protect from a revenue and cash flow basis, but also offers participation to the upside that if prices run, we can participate in, and shareholders, that's why they buy these stocks, are there. So I take a lot of comfort in the fact that, again, we look at this business full cycle, and as part of that, it's cost control. It's making sure you have the best margins. Everything we do is, what is the break even? What is the free cash flow break even of that asset? We're mid $30 WTI break even corporately, including the base dividend full cycle. There are not any companies on the oil side that can say that. So that makes me happy. That makes me comfortable. And it shows you we have the discipline that we can manage and are resilient through the cycle with all of those pieces we have in place. But I couldn't agree with you more. It is in our DNA as this industry to get really excited, and you have higher highs and lower lows, and that's just the way this business goes. But I think we at Tamarack do a pretty good job of managing that and staying pretty disciplined and calm through all aspects of the cycle.
Seems like, despite the fact that you're the CFO at an energy company, despite the fact that we're in downtown Calgary, the common themes that keep coming up are the lack of supply, maybe some ESG pressures, and maybe some tensions in Europe that are really providing the opportunity for higher prices going forward.
Yeah, and so we touched on the war for sure. That supply disruption, that's short term though, hopefully, from that standpoint. ESG pressures is probably the biggest topic. And I want to be very clear. We believe in orderly transition. We want to be a leader. And I talked to you about that. We as a company see ourselves as a leader in ESG. Yeah. But ESG doesn't mean dropping fossil fuels and going to green initiatives overnight. It doesn't happen. And we look what's going on in Europe right now. Obviously, the canaries in the coal mine. We have to do a better job. And we would love governments to work through the industry who have lived and breathed this our entire lives in transitioning, right? So I think Canada and the Canadian industry in general, the energy industry, has to do a better job of educating how good we are, but not only on the environmental side, also on the social side of the spectrum, because, and governance. We have very strong labor laws. We take care of women in the workforce and diversity and things like that. You look at Indigenous workforce representation. That's something that's obviously very near and dear to Tamarack, and one of our sustainability linked goals and targets, KPIs in our bond. These are all things that don't exist in other countries to the scope that they do here. So when you look at ESG, when you look at, I think, just the way we as an industry run our business, we have a lot to share and we should be very proud. But I want to make it clear too, we've got to do a better job of educating, but we also have to do a better job helping with this transition. And it's not going to happen overnight, but we need the support to help with the transition, because we all agree something's got to be done, but it can't be done by just flipping a switch. It can't, right?
A pragmatic way.
It has to be pragmatic, it has to be inclusive, it has to be educational. There's a lot of pieces that have to go in here.
A few weeks ago, the Canadian government announced a tax on share buybacks for Canadian corporations. What is the tax on the buybacks that the Canadian federal government recently announced? And do you think how will that affect Tamarack?
Yeah. So, there is a tax on buybacks moving forward that was announced, and we have been buying back stock. The industry as a whole, yeah, it is awesome. And the industry as a whole is buying back a significant amount of stock, which I think speaks to, the health of the industry finally, but also the undervalued aspect of where many, boards and management teams would see their equity. Is it going to change the way I think industry looks at this? No, I don't. At the end of the day, it is a tax, but I think it comes down to, and at least the way we would run our business here, it's a fundamental intrinsic value question when you're buying back stock versus paying out special dividends. So every I'm not going to speak for other CEOs and executive teams or boards, but they're still going to evaluate whether they buy back the stock or not with this tax in context. I don't think it changes it materially. Do I see maybe an SIBs and bigger buybacks expedited ahead of that? Sure, I do. But again, I think every management team is going to have a different answer for you depending on how they look at that. I would say here, the way we look at return on capital is we've bought back stock. But again, as I've talked to you about that 5-year plan, 55 deck, we buy back stock if our intrinsic value is at that share price or below. Anything above that share price, we would be probably leaning towards paying out special dividends. When we look at buybacks in general, I think Brian and I would view buybacks more as a defensive mechanism, because when you have a lot of free cash, it usually means your stock, the commodity price is better and the stocks are higher. The timing of the buybacks, I think you got to think about too. And that's why we really tie it to our intrinsic value at that 5-year plan. Special dividends are more offensive. So I think they make sense in the context of the market as we see it now. And, I do think if I look at some of the companies and how they've managed it, I think Tourmaline's got a pretty good recipe for success around how they are managing all of that and look at it. So, and others. But again, I think every team, getting back to your question on the tax, is going to have a bit of a different view and a different answer.
As the CFO of an energy company and probably CEO too, one of your main jobs is capital allocation. How important do you think that role is? How do you learn the best practices? And what do you think the best practices are? Or do you have people you look towards? How do you think of that role?
Yeah, and it's very important. And it falls on not only the CFO or the CFO like myself, it perforates right through the organization. We actually want everybody thinking the same way, so we're aligned at a corporate level.
Do you read Berkshire Hathaway reports?
Yeah, exactly. At the end of the day, when we look at capital allocation, I think we've got away, and the industry is getting away from looking at a 1-year type rate of return and payback to payback in what we call PIR, or profit to investment ratio. How many times do I get my money back? What's the resiliency of my dollar that we're investing? Yeah. So we try to balance that. So a good example, if you look at our portfolio, the Clearwater, well, that pays itself out 2-3 times in a year. The Charlie Lake pays itself out a couple times in a year. So if you really were looking at highest rate of return, quickest payback, you just go there. But then what does that mean in years 2, 3, 4, and 5 to my decline, if that's all we're doing? We have to make sure we balance. And the way we look at it here is about 25 cents of every capital dollar gets invested into secondary recovery. So we try to manage that longevity and, again, that resiliency of how many times that dollar's paying you back. And, one thing I'd say is we got a really interesting slide in our corporate presentation that looks at a Clearwater Martin Hills average well versus the Permian top tier Delaware well. And they both pay out for the first time in roughly the same period, like about months. 6 months. But the Clearwater well, again, pays out a second time in the first year, where that Permian well, you're almost pushing year 3. That comes back to that resilience of the dollar. On a primary Martin Hills well, you're getting 5-6 times payout. Over the Permian well is only getting 3 times payout over the same time period. So that 5 years. So again, it speaks to sort of how we have to look at that and manage what type of assets you target, but also understanding full cycle, what you're doing today, how does that affect tomorrow?
If you're trying to run a sustainable business, you've got great wells now that are awesome. They might not be around forever though. So how do you think of it in terms of managing capital correctly now versus maybe assets down the road 5 years from now? Do you have like an R&D budget or some wildcat drilling? How do you think of it?
Yeah, that's a great question. So there's two answers to that question. One, what you have to do is you have to make sure the growth you have in your business works with the duration of your inventory. So to your point, if I have 8 strong years of inventory plus another 4 left over, I can pull some of that value forward. But if I only have 6 years of inventory, that's going to dictate a lower growth rate, right? Otherwise, you're going to get into trouble.
Inventory in the warehouse.
There you go. Yeah. So it's a widget. You have to make sure you have enough. The other aspect, and you hit the nail on the head, and we don't call it wildcat catting here, but we have what we call a de-risk budget that's incorporated in annually into our numbers. It's about $25 million. And we work that back. How do we come to that number? We look at an F&D sort of equation on how much resource do we have to find and what does the cost to take that out of the ground look like? So we're always looking at that to balance the long-term growth aspects of the business, but also the duration of the business.
Right.
But that has to be something you're committed to every year. If you're not doing that, you're always going to be a year behind or 2 years behind. So we do both those things to ensure that, we're moderating and ensuring that we have the proper allocation of growth and capital spend in our business.
Maybe making sure you hire that brilliant summer geologist from the summer.
That's right. And you know what? I'm glad you brought that up. That's the other piece. So part of allocating capital is making sure you're consistently bringing in the right people and having that succession plan and that right path to a learning culture and a learning business. And so summer students are huge here. Yes, we bring them in and most of them come on full time. We really support Indigenous education opportunities, both in the field and bringing them into corporate office. So all of these pieces are important to us. And that's part of investing in the long-term duration of the company is your people.
Well, that's a great conversation. I really appreciate your thoughts on the industry, thoughts on Tamarack, where things are going, capital allocation. If you were to leave the listener or the investor with one or two thoughts on Tamarack, what would you tell them? Yeah,
in general, I've been in even though I'm a younger CFO that you brought up, I've been in the energy industry for my entire career, and I've never seen a cycle setting up like this one has. What I really like is how we're seeing a behavioral change and how this industry is approaching the new cycle here. And I think in general, that excites me. I think there's a lot of opportunity. When I take that back to Tamarack, I've only been here now going on 3 years. But I think what we've been able to do as a company and repositioning this company into the best plays in North America, the people we've been able to attract and bring in to make our, help build the company and build the culture. I'm just super proud. I'm excited to continue to build the business with the team that we have here and the board that we have here. And I'm just really appreciative of the support that we've received along the way. But like I said, I'm excited. I'm excited for Calgary, for the energy business. And I think Tamarack is going to really show well as we continue to build and grow this company.
Well, thanks a lot.
Yeah, thank you.
Thanks for listening, everyone. Hopefully you enjoyed the episode. If you liked what you heard, check out rosebros.ca, where we will have upcoming shows. Until next time, happy coffee drinking.